Emerging markets was once the darling of the investment universe. Virtually ever since Jim O'Neill from Goldman Sachs coined the term BRICS, those that had invested in emerging markets, either directly or indirectly, made great returns. This is either because emerging market equities outperformed their developed market indices, or because emerging market debt did well and credit spreads came in. However, the past 3 to 4 years have been much more challenging, and investors' recent experience hasn't been as happy. For example, many investors have experienced returns from emerging market that have been significantly lower than developed markets. Many active managers have underperformed their benchmarks and often incurred higher fees in doing so, and that's been a very uncomfortable trifecta. This is a particularly topical issue given recent market volatility and raises many questions. Is the whole emerging market investing just a fad? Is now a good time to increase one's exposure to emerging markets? And if so, how should one go about it? Today we have 2 industry participants with excellent emerging market experience to share their experiences and views. Ralph Jaeger will make the case for emerging markets private equity, which is one of Siegel LeGuff's most successful strategies, and Craig Matthew from the Capital Group will talk about more holistic ways about thinking about emerging markets. Interestingly enough, Capital Group has few private equity products, but one area where they do private equity is in emerging markets. Can I please introduce Craig Matthew from the Capital Group to talk about emerging markets, in particular about how one can go about investing in a holistic product that incorporates both emerging market debt, emerging market equity, and changing between the two. Thanks very much.
Thanks, Michael. So I think the session title was Emerging Markets, How to Get the Best Results, just as simple as that. And a few weeks ago when they approached me to speak on this, I thought, well, this is an interesting enough topic. A few weeks later to now, it's feeling slightly more complicated, but nonetheless, work with me on this. Perhaps then, actually, it is the perfect time to refocus on things, because after all, it's not a story about a month, it's really a story about an evolution, and frankly, how quick we are to compartmentalize what the emerging markets are. I think we agree on typical questions, whether it is a good time to go in. That seems to be something I get posed with a lot. Should we step up the allocations? Should we scale back to the benchmark and perhaps play it conservative? And more topically to Michael's point now, how do we factor in China? I think we also agree on the challenges themselves. The reality is that early allocations to emerging markets in the last couple of years has been incredibly painful. The rally in the developed markets has just been unmatched in the emerging markets, and that has been costly to each of the people in this room in different ways. You add in then the investor pursuit for yield, and it establishes different concerns, this time in emerging market debt, in the sense that there is potential crowding there as people have been looking for yield wherever it possibly exists. Volatility, as Michael pointed out, the corrections there are just painful. Going back into the mid-90s through the end of the 2000s, there were 3 separate declines of more than 50%, and not all of them are particularly quick. The one in 09, you'll recall, in 08, 09 was up by 80-odd%. But when you fall by 50-odd% and you rise by 80%, you're still down by 16%. The math is particularly cruel. So emerging markets, which used to be exciting, I can remember a time when they were very exciting, are now actually perhaps filled more with frustration. So how do we navigate this? Is it really an on or off kind of question? And frankly, how do we disentangle from all this volatility? We wonder if perhaps we should take our cue from what members' needs are, and that is to limit volatility in every way that we possibly can. And we think that now emerging markets have actually evolved to a state where there are new options to be able to moderate volatility and reduce drawdowns that are quite effective. Ultimately, if you can keep your investors to stick to a plan, then emerging markets belongs as part of a long-term solution. So let's. Sorry. It's just the challenges anyway. Let's look at how this adds up. The fundamentals, at least the way we look at the world, are still very much intact. So emerging markets are slowing, but they're not slow. Certainly, the best growth is still in the emerging markets. The bullet points on the top left there illustrate some of the key points I think we agree on in terms of better growth, better demographics, and rising living standards. The top right circle there shows the percentage share of global GDP, which is substantial. But perhaps most compelling is that bottom circle, which shows the contribution to global GDP growth at close to 70%. And I acknowledge that GDP growth does not equate itself necessarily to strong market returns, but the point is that there are going to be some substantial winners in there and substantial losers that you need to get your head around as this eventuates. That evolution in the emerging markets has been alive and well, whether we invest in it or not. If you consider what inflation was in the emerging markets a number of years back, 100% was not a ridiculous number. Inflation now to be more around 5% odd is just more realistic. It's more akin to what we see in the developed markets. Structural reforms, legal reforms, property rights, and so forth have all evolved significantly. So it's not that the emerging markets are without issue, but they are a heck of a lot more stable than what they used to be. So arguably, it's really not if you do the emerging markets, it's how you navigate through this and take advantage of this exciting growth. How do you capture concepts like in 10 years' time, of the high-income consumers, 65% of them are going to exist in emerging market cities. 2/3 of high spenders are going to be in these cities. So you have to get your head around spending evolving. Taking a closer look at this, let's go right into to China, which is certainly the most closely watched and ultimately may become, if not already, the largest. China's an interesting one because they're basically going through a transition from a closed environment, one that is more manufacturing driven, to a consumer driven market. And you can see on this chart how this has evolved since the mid-90s till more recent times. You take a look at the largest wedge on that circle, and you imagine a time where more than half of your income is spent on food and clothing on an annual basis. Of that, on that graph on the left, 50% of people's income annually was going to food. Now it's around 15%. To go from 50% to 15% is just a massive change in the way that you look at life. Some of these things are frivolous and some are not. Healthcare is an important concept to get your head around. Travel and leisure, all of these are things that we talk about regularly. And of course, some of us are exposed to Sydney real estate, which is not necessarily on this demographic, but it's not a good one either. This is going to impact different companies around the world in different ways. It's really not just a China thing. But again, how do you untangle this behemoth? And better yet, we wonder, why is China of its scale in this other kind of a category? It's a bit puzzling. This next slide is, I think, an important one. Because to look forward, we need to look back. And there's been substantial evolution in securities that are available to market in the emerging markets. Yet we discuss emerging markets in the same way that we did decades ago. So in the late 80s, early 90s, there were a handful of countries, one of them being Jordan, that represented about 1% of market cap. It was full of dreams, but not necessarily market capitalization and real companies. You fast forward to now, and it's 23 countries with nearly 20% of the world's market cap. The liquidity is better, the companies, there are more to choose from, we're just in a different phase. We think that we're also perhaps guilty of inaccurately compartmentalizing what the emerging markets are. For example, the notion that emerging markets are just filled with companies that reinvest cash. It may surprise some of the people in this room to recognize that in fact 90% of companies in the MSCI EM index pay dividends. And right now it's around, actually at least in a few months ago, it was around 3%, which is higher than the S&P 500 or the MSCI World. So it may even have a role in terms of income portfolios. On fixed income issuance, you can see some of the numbers on here, to go in the space of 10 odd years from 60 different corporate issuers to 552 is just a totally different beast. And yet the conversations we're having now are perhaps similar to the conversations we were having in the early 2000s. Headline risks are abating. Over the space of the last 20 years, this has gone from 1/3 company-specific to 2/3 company-specific. In other words, investors are now differentiating between macro factors and headlines and looking at company specifics. Going to 2/3 from 1/3 is substantial. But what I actually find most interesting about this is that that is the same ratio as what you see in the developed nations. So it's further evidence of maturing. So the key is to invest in high-quality businesses, not countries that can stand political upheaval or currency declines or what have you. So if the emerging markets themselves have actually evolved, then how can we evolve the way that we invest in the emerging markets? If you were starting from scratch, you might be tempted to approach emerging markets like the developed markets and basically keep an equity bucket and a debt bucket separate. And we did this for years. Capital Group has been running emerging market equities since the late 80s and emerging market debt since the early 90s. And the original case around this was quite compelling. After all, in developed markets, the correlations are around zero, and it smooths volatility. It's great for people in retirement, all these great things. But the challenge has become that emerging market correlations are quite a bit higher. And depending on the indexes you're looking at, if you're going the same direction, 8 times out of 10, you're not playing the same correlation game. So if emerging market debt is affected the same way by macroeconomic and market forces, the question is this problematic for top-down strategies? Looking at developed markets, if you were to invest in just the market, it arguably is reasonably diversified. For the emerging markets, however, given this state of evolution, it's a little bit more lumpy and difficult to perhaps approach. To be passive, we would argue, in emerging markets is more challenging. Perhaps this is best visualized with emerging market debt, which is largely a function of that issuance that I showed a minute ago. You add to that where we are right now, and you see that there's a significant amount of complementarity. So in Asia, you basically have a lot more equity issuance than you do in fixed income, and vice versa. In Latin America, you have a lot more fixed income issuance than equity, which can give you an unintentional tilt bias to the asset class, depending on which one you're looking at. So how do you compare then a company that might only issue itself or expose itself to the listed public markets by way of a bond in Argentina, or compare that to a company that only does it by equities in Korea? It's very challenging. And you add to this where those companies actually do their business anyway, and it leads me to my next point, if I can get there. There we go. Further complicate this evolution with where companies actually do their revenues. Where a company is listed used to be accurate enough, but now that companies are progressively multinational, or if they aren't, then their suppliers are, their customers are, they're managing their own currencies in different ways. To be geographically building your portfolio is increasingly disconnected from the fundamentals, we believe. This chart is a bit simplistic, but I think it makes the point that considering companies by where they're listed by domicile, 60-odd% is in the US, but by revenue, it goes down to 46%. And conversely, you're looking at emerging markets, which in the MSCI world has no representation, and yet 20% of the revenues actually come from emerging markets. Now, you can obviously solve this with ACWI or picking a different index or what have you. Most of us, I think, agree with this conceptually, but the question is, how are we actually factoring it into portfolio construction? We call this the new geography of investing, and ultimately it's about following actual revenues. Why am I mentioning this now? We think that this is one of the things that in emerging markets has definitely evolved in the space of the last 5 to 15 years. And if there is a new lever there, it's really the amount of data that we can get on emerging market companies, which makes it very intriguing to follow the actual revenues rather than doing some of the guesswork. You might wonder, does this work in Australia? We would say arguably yes. About a third of the revenues of the ASX come from outside of Australia, but what kind of exposure is that? Is it ideally risk managed? Not surprisingly, a lot of that comes from materials. So on the right-hand side, you see an example with BHP. But other than that, arguably, it's just not that much, and it's certainly not a complete intentional risk package. We would prefer, ideally, if you were to pick companies that had these exposures, to capitalize on thematics that might be interesting right now, whether it's that emerging consumer or consumer technology, branded goods, pharmaceuticals, and so forth. So for this audience, if you're really trying to move away from home country bias to the extent you can, with a heavy nod to risk, we would argue that this new geography of investing and looking at companies' revenues is an incredibly important part to take into consideration for portfolio construction. A quick example of this, if you're looking at emerging market healthcare, which is very pressing in China, one consequence of China's growth is that they're also getting Western lifestyle diseases. This is fascinating. Diabetes, China actually has the largest number in the world. That's a full 96 million people, which is 3 times the amount of diabetes cases that are in the US. In 20 years' time, this is going to go up by another 46 million people, or twice the population of Australia. The numbers are just astounding. And certainly this is a sad state of affairs, and we need to locate treatments that cope with this, regardless of the state of growth in China. But where are these solutions? Arguably, they're not necessarily in China. So here's an example of a company, Novo Nordisk, insulin maker. They're based in Denmark. They've been around since the 1920s. They're not new. They actually have a 50% share of the global insulin market. In China alone, they have 57% market share, distant leader, much more than competitors. And already, before that growth, they're already, China is third in line after the US and Europe. So is Novo Nordisk Danish? Does it belong in a developed portfolio or an emerging market portfolio? You know, the concept here is emerging market healthcare. We would argue it doesn't matter. I think it was Mary McLaughlin made the point about being provincial. You know, that's a big word for this, but the concept is the same. You're trying to focus on where the revenues are actually going to come from. So it's a good example of following revenues on a global basis. So for this audience, I think we all agree on the longer-term case for emerging markets. It's just a case of that shorter-term volatility. And in emerging markets, I mentioned that some unique opportunities exist. We would argue that, regardless if it's us or anybody else, that basically you should look at the emerging markets comprehensively, which is a powerful way of looking at the world. And you basically maximize the number of tools that you can manage risk and return. You take advantage of that new debt and equity issuance, and you don't just go along for the ride in a passive way. We think that that is potentially problematic. We can expand on that later. But emerging market debt, a lot of the feedback we get is that, you know, of course you're going to have less volatility if you put in emerging market debt into an equity portfolio. The reality is a lot of emerging market debt, think of that Latin American example, actually has just the same amount of volatility, if not the same amount. So it's not necessarily a volatility thing, but it needs to be managed. Sometimes emerging market debt is the only way to access these countries. Sometimes you want to build a theme across equity and debt. Sometimes you love a company, but you want to choose which side of the capital structure you're actually on. So going back to that example of an Argentinian company that has a bond, or it's only available by bond, versus the Korean company that is only available by stock, in this conversation, it can come alive. It's basically a bottom-up approach across the board, as opposed to bolt together. And concepts like the frontier markets, you don't have to be in them all the time. It's part of this investment landscape. It's not being wed to geographically led issues. Emerging market linkers can be very powerful and interesting, but again, you may not want to be in them all the time. So if you consider it part of this higher correlated landscape, then it becomes a bit more interesting. Ultimately, it's about letting go of geography and focusing, in this case, on volatility instead. So volatility becomes your objective. So what do we do with all of these new levers? On the left-hand side, you see the traditional framework, and ultimately it's basically geographic boxes. In the way I've been describing things, it's no surprise to understand that the companies themselves don't actually fit in those geographic boxes, and that's the challenge. So whether a emerging markets or Australian company, where does it fit is just increasingly inaccurate. Is now a good time for emerging markets is just not that simply defined. It's really about the thematics behind it, and geographic is just progressively less relevant in a globalized world. We think that the pivot in emerging markets, at least at this time, because of this uneven evolution, is to focus on the investment objectives in building blocks, which is coincidental to the way that a lot of super funds actually look at the way things go. But ultimately, this allows you to take a look at emerging markets as this single asset class built by revenue construction, focus on the appropriate time horizon of your members, and scale accordingly, which is not too complicated. It's not rocket science, but you really have to employ your managers to be able to have that kind of discretion. In fact, we believe it would be an incredible disservice to avoid increasing this scale over time to match some of the growth that truly exists there. So the takeaways that I would mention, we started this by looking at the case for emerging markets and now. And ultimately, we do think that despite the noise, this case is absolutely intact. It is slowing. Emerging markets are slowing, but they're not slow. Emerging markets through geographic silos is missing an opportunity. You should allow managers to follow companies by their revenues and consider multi-asset investing, at least for emerging markets. We think there are pros and cons for other parts of the market, but we would argue that this is an important tactical way to weave this into your portfolio. It's actually a pretty exciting proposition when you look at this, because it allows you to scale up the emerging markets without being as worried about the volatility as the world ebbs and flows with things that are going to be different but always present. Bottom-up research does not go away. Top-down fundamentals absolutely still plays a part, but you basically participate in global growth wherever it is. This notion of emerging markets in portfolios for retirement because they have income, I think is also lost in all of the noise in terms of portfolio returns, but it can be a helpful part of the solution. So if you're going to create a strategy that embraces the evolution at this stage, we would argue that multi-asset investing is the appropriate way to look at this. And anything that is easier for members to live with actually will allow us to move forward, perhaps, in these conversations. Thank you.
Thank you very much, Craig, for that very interesting presentation and for your courage in presenting something that's obviously so much on the nose at the moment. I'll leave you to think about your answer to the inevitable question, is it the right time to invest in emerging markets, or is it a bit like catching a falling knife? I wonder if any of you now get the whole theme of what's going on here. If you were around for lunch yesterday, it was all about the cowabunga dude and his wife doing bungee jumping. And now we're talking about emerging markets where the price action looks a little bit like a bungee jump. Despite Craig talking about the sort of assets that he invests in at Capital Group, some of the best companies in the developing markets are private companies, and the best way to access those might be through a private equity manager. So please let me introduce to you now Ralph Jaeger from Sigler Guff, well known for their private equity, but also some other very innovative alternative strategies. So, ladies and gentlemen, Ralph Jaeger.
I don't have a presentation. Starting out in comparison to the very interesting presentation that Craig showed, I'd like to start out with a question: how do you access the growth in emerging markets that Craig was talking about? And that's where really private equity comes into play. I have a bias for private equity in emerging markets. I will preface that, of course. That's why I'm here. Michael tested me on my general biases for things. He asked me about my preference for soccer or football clubs in Turkey, specifically in Istanbul. I happen to have lived in Istanbul for 6 years, and I didn't really explain why I had a bias. I told him it's easy. I was dating the coach's daughter, so I have a bias. I have a biased approach to things, and I have a bias for private equity emerging markets because that's where we've had the strongest performance. And that's where you've had performance overall over a decade now, by far eclipsing the performance that you've seen in public markets, and by far eclipsing actually performance that you were able to get in developed markets. Access to the growth sector in emerging markets, and I use emerging markets loosely as a term because I agree with Craig that markets behave very differently, but by and large, you want to have access to the growing consumer class. That is really all about accessing the growth. And when you look at the indices or the public markets in emerging markets, oftentimes you will see that it's difficult to access that growth category or that middle class. We talked about urbanization in China today. Urbanization means require services. I want education. I want healthcare. I want to go on vacation. I want more services. There's a reason why Alibaba is growing as much as it has over the past 5 or 10 years by now. But you can't access those companies through the public markets. And if you do, you buy very expensively. So the question is, how do you access growth and value in emerging markets? Because that's really the approach that you need to take in order to generate strong returns. In comes private equity. The private equity asset class, if you want, for lack of a better term, in emerging markets, behaves quite differently than I think what people might think. And before I joined Seguros Lagaf, I happened to have had a stint of almost 5 years at a consulting firm, and I'm sorry for that if people have certain biases against consultants. But I was on the research front, and we looked at behavior of client portfolios in emerging markets, specifically when we looked at private equity. I was co-head of private equity research international, focusing on emerging markets. And when you looked at client portfolios' behavior during the financial crisis, those that had exposure to emerging markets, private equity, performed a lot better than those that did not have exposure to private equity in emerging markets, by 400 to 500 basis points compound performance over a 10-year period. That was quite significant. So we analyzed why is that? Well, because, again, the access to very different sectors, to yielding companies, to cash flowing companies, to high growth companies, accessed at very attractive valuation, 40 to 50% below what public market valuations were. So think about that. Private equity, emerging markets, role of those in your portfolios. Emerging markets, private equity performance. We've talked about public equity performance. Is it a fad? What about the last 3 or 4 years? Well, if you look at private equity performance in emerging markets, and you take the top half, so the first and second quartile, which is where you want to have exposure to as a cohort in private equity, and you go back over 10 years, as of, let's take March 2015 numbers now, and look at 10-year periods, 19% performance, annualized IRR. That's huge. Let's go back only 5 years, 19.6%. Let's go back 3 years. As of March 2015, your performance 20%. So wait a moment, you have very strong performance in emerging markets if you had access to private equity. If you look at private equity and you compare emerging markets to developed markets in private equity, and you go back a decade and look at each vintage year, over those last 10 years, 7 years out of 10 years, emerging market private equity performed better than developed private equity. So I think it's a misconception to think that emerging markets by and large have underperformed, because you do need to peel the onions and look at subcategories or ways of accessing emerging markets, and private equity has performed well in emerging markets over the last decade. We talked about sectors versus publics. We talked about the behavior of emerging market private equity versus private equity in developed markets. Now the question is, what are the risks, obviously? And the risks of concentration are strong in public markets. You can actually diversify risk away through a diversified private equity approach, which is important to appreciate the fact that if you do not have a diversified approach to emerging markets, and that goes as well for the public markets, then it becomes very risky. And then you have volatility in your underlying portfolio. So key is to have a diversified approach in emerging markets and allow the managers to then select within those with regards to strategies, also with regards to geographies. If you go back to this kind of top quartile cohort analysis, and you go back 10 years, all the way to, actually you're going to go back 15 years, and you look at the evolution of what regions top performance has come from, that changes year by year. So you'll have vintage years where you have strong performance coming out of Chinese managers and Chinese deals. And then subsequent to that, you'll have years where you have most performance coming out of Latin American situations. So at any given point in time, it's important to apply this relative value prism in order to get the best returns from your private equity investment approach. To give the manager the flexibility, if it has the capability or the skills, to do that selection for you. Again, going back to Craig's point, if you narrowly define sectors or geographies, you will make mistake, because you'll force yourself to invest specifically in an area where you might get returns for certain points of time, but then you'll lose the returns over other stretches of time. Why is now an interesting time to invest in emerging markets, given the headlines, et cetera, et cetera? A couple of things come to mind. Valuations have come down quite significantly and still have ways to go. I think we'll see China valuations still come down quite a bit from where they currently are. In Latin America, we've seen the Bovespa come down, but not quite as much as we've seen it in the last two crisis situations. And those also then suggest that you can create companies or can create deals in private equity at very attractive valuations. Interesting valuations, and you overlay that with an interesting foreign currency situation, is usually conducive. It's a confluence of variables that should be conducive to generating strong returns. And we've seen that in the past. If you go back all the way to 2003, and you create a currency basket, in 2003 was as low at a point as it is today. So essentially, we're having a low point right now on currencies in emerging markets. The best performing vintage year in private equity in emerging markets was 2003. Now, will we have the best performing vintage year? Who knows? But from a currency point of view, at this point in time, you'd think it's conducive to generating strong returns. And you see actually very strong correlation if you go back and look at 2003, 2004, 5, 6, 7 vintage years, and we stop then because those are essentially baked funds, that as currencies increase, returns come down, as you would expect. So an entry point is attractive from a currency point of view, entry points are attractive from a valuation point of view, and you have capital scarcity. You have a lot less foreign investments going into some of the markets, especially in Latin America. Capital scarcity is always an attractive environment to create private equity opportunities. Banks don't lend readily to private companies. Capital will be much more allocated to state-owned enterprises in China, for example. 70-75% all goes to state-owned enterprises. So private companies that grow fast in their respective sectors need capital to grow. You have very attractive opportunities now as markets are somewhat maturing to conduct M&A opportunities, and essentially to buy the second or the third companies within your respective markets. So those are opportunities that are interesting, that we like, that we see ahead of us, and therefore we would encourage folks to think about emerging markets in terms of accessing it through private equities. The question then is how you implement. One thing is, it's nice in theory, but then how do you actually go about it? I mean, what do you look at in private equity? Is it large, is it small, is it sectors, whatnot? So I think sector is a very clear aspect of the strategy that you need to implement, catering to the growing middle class, absolutely key. So you do not do materials. We don't do extractive industries, you don't do utilities, you don't do financial services. Those have a lot of volatility. Those are oftentimes prone also to regulatory uncertainties, much more so than normal, quote-unquote, normal private companies in the private sector that benefit from more normal market environments and market economies, if you want. You also want to make sure that you have enough access to smaller companies. The smaller companies in those sectors are the ones that show the biggest growth momentum, and also that are a lot less pricey than the larger companies, as a function, again, of scarcity or lack thereof. Larger companies or funds that pursue large company acquisitions don't have many companies to choose from. So when you have companies that are available to be bought, oftentimes these are auctioned, thereby driving up prices. So your price difference that I mentioned between a private equity strategy that ought to be 40 or 50% below public equity valuations, all of a sudden the delta becomes a lot less. And if you give that up, you do not create enough returns for your private equity risk in emerging markets. So it's very important to have a focus on the smaller end of the market spectrum, the mid end of the market spectrum. And then again, you want to have a diversified approach across geographies, as I mentioned. We see a lot of opportunities in Latin America over the next 1 or 2 years. After 2 years, there may be less talent, so you're going to rotate. We'll see more opportunities in China. I think China still has some ways to go. So we'll be a little cautious for another half year or year before putting more capital to work in China. We're interesting acutely observing what's going on in Africa. Africa has been absorbing a lot more capital, which at the same time is a bit of a concern, right? Whenever there's too much capital going into some markets, you want to take a pause. Africa last year raised 5 times more than the average annual fundraising over the last 5 years. So a quintupling of capital that's going to Africa. Now, surely Africa can absorb that capital, but if you have people looking at buying all the same assets, then that will drive prices up in those respective assets. So we're a little cautious on Africa. We like what we see in Southeast Asia. We've seen a lot more momentum, specifically in Indonesia and Malaysia. I think, again, very attractive currencies, very much more attractive valuations at this point in time. So that's an area that's of quite interest. And significant companies also that are scaling when you buy them small, and you can still scale them up, and then you sell them to multinationals or into the public markets, which creates a very attractive arbitrage, if you want, or value creation opportunity from that point of view. That's kind of it, if you want. The last thing I will say when it comes back to a comparison of private equity performance in emerging markets vis-a-vis the public performance in emerging markets, and I'm taking the MSCI index for now. Going back to what I said, you have access, assume for a moment you have access to the top half of the funds on a pooled basis. Over the last 10, 5, and 3-year periods, the outperformance over the MSCI index at any given point in time was between 1,200 and 1,800 basis points on a comparative basis. So in other words, if you want to get compensated for the risk that you take, I think that's handsome compensation.